Welcome to the Passive Investor mini lesson. In this mini lesson, we're going to talk through the passive investor real estate activity type, which makes up the vast majority of all people investing in real estate in the United States. Let's jump into our agenda. And talk through what a passive investor is under IRS publication 925. We're also going to talk through if you have rental losses. Now, we always talk about that cash flow versus tax flow. And when we talk about rental losses and teaching tax flow, that doesn't mean that you're not making money and you don't have positive cash flow. We're talking about losses on your tax returns that are primarily due to that depreciation deduction and that difference between tax flow and cash flow. So if you're a passive investor, when can you deduct those rental losses? We're also going to look at the little bit technical side of things is where you report this rental activity on a Schedule E. And also, we're going to look at Form 8582, which is a very, very important form for any passive investor that we're going to look at our calls to action. Let's first look at IRS publication 925. So there are two types of passive investors, okay? There are two types of passive activities, just like the slide says. Trade or business activities which you do not materially participate. We have another mini lesson on material participation, but in general, if you're in a business, even if it's in a Schedule C business, and you are not materially participating, by default, you are passive in that activity. The second one is rental activities. Even if you do have material participation, unless you're a real estate professional. So by default, rental activities are a passive activity according to IRS publication 925. So if you're involved in rental activities, you are by default a passive investor. Now, again, there's that material participation and there's real estate professional status. Those are two separate mini lessons that I encourage you to check out and are part of this TTF REI course. So let's look at teaching tax. TTF considers passive investors to be businesses and individuals that engage in passive activities. All right, so there are some examples here, but just think. Two categories of passive investors. One, real estate investors by default, unless you meet some type of special exception. Two, you're in a trade or business which you do not have material participation. Now, this flow chart here, and you might want to pause the lesson and look at it, really helps passive investors determine when they can deduct those passive activity losses. And those losses can come from rental properties that you own. It could be from a rental syndication. And when can you deduct those? So as we work through, if you have if you dispose of a property that has passive losses, then at that point, you could deduct those rental losses. You're harvesting those passive losses. So let's look at the flow chart here. Follow my cursor. Do you have passive income to offset the losses or qualifying distribution? If that's a no. So you have passive losses. You don't have passive income. You don't have that PIG, another TTF mini lesson. Then do you actively participate in your rental activities? If the answer is no, then you are in the passive investor category and you're just going to have those passive activity losses. We're going to look at that in a second. If you have active participation in your rep status, real estate investor, your real estate professional status, then we're going to flow down to ask, do you have material participation? If that's yes, then rental losses are deductible. If you are if you're not rep status, and then we have some income limitations on when you could deduct your passive losses. And these income limitations are here. So the point is, figure out if you're a passive investor. If you are and you have losses, work through this flow chart to determine when you can release or utilize those losses. Obviously, being real estate professional status really helps, or having a lower modified adjusted gross income helps as well. But the vast majority of people with passive losses will have those passive losses carry forward. So let's take a look at the forms we're going to report on. We're looking here, Schedule E. This is a common form in teaching tax flow. This is where you report rental properties, either owned personally or a single member LLC. And we have a whole separate mini lesson on reporting of rental activity if that's not the case. But what we're looking at here is Joe and Jill tax flow. They have 123 Main Street, Franklin. They actually have a loss on this rental activity. Remember, one of the laws of teaching tax flow, cash flow does not equal tax flow. So this, even though they have positive cash flow, because of that depreciation deduction you're looking at here on line 18, it creates a loss on their tax return. That $1,500 loss is not deductible in the current year for Joe and Jill tax flow because they're a passive investor. Now that loss isn't gone, it just carries forward as a passive activity loss carry forward, which brings me to this next form, 8582. Form 8582 is the form that tracks your passive activity losses. And those passive activity losses can come from a variety of sources. We saw Joe and Jill tax flow have that for this immediate year, regular or current year $1,500 loss. They have $3,500 of prior year losses from their property on Main Street. So this 8582 form is what you want to look at if you're a passive investor to track those passive activity losses, and we always want to release those losses legally and ethically. All right, a lot of information for that passive investor status, but let's hit our calls to action. 1, figure out if you are a passive investor. That's step 1. And if you are, review your form 8582 and work towards being able to utilize those losses. Passive losses might fully or partially be deductible based on your income and active participation. Remember, active participation is a different concept than material participation. Material participation has a series of tests. And again, we have a separate mini lesson for that. If you are a passive investor with loss carry forwards, consider investing in pigs. We call it hunting pigs, and that's another mini lesson and part of this course. And potentially electing out of bonus depreciation. What that means is that if you have property that's eligible for bonus depreciation and you have passive activity losses, you might want to elect out of that depreciation, because if you sell the property, the depreciation recapture at this point is at a higher tax rate than capital gains. So you actually want a higher basis, since that deduction is not going to help you in the current year anyway. All right, thanks for watching this mini lesson and have a great day.
John here from Teaching Tax Flow. I wanted to thank you for watching this video. We literally have hundreds of hours of content between podcasts, webinars, videos just like this built specifically for you, the taxpayer. Whether you're a full-time employee, you're a freelancer, you're a contractor in some other sense, or you're thinking about getting into business for yourself, everything here at Teaching Tax Flow is perfect for you, basically going off of the roadmap provided by the IRS to legally and ethically reduce the taxes paid over your lifetime. So be sure to subscribe to this channel and connect with Teaching Tax Flow, and we will see everybody very soon.